Hey guys, welcome back, and in today's video I'm going to be talking about what the difference is between a recession and a financial depression. Now this is really crucial that you understand this, especially in the next couple of weeks, because there are going to be some big announcements on the news and I want to prepare you for something in advance. So this will be one of 2 or 3 videos. The next video, which will be released in a few days, I'm going to give you my detailed analysis on whether or not we're going to go into a financial depression and actually how to protect yourself against this. So the last time we had a recession was in 2008, known as the Great Recession. So let me start by explaining what constitutes a recession, and then I'll go on to what constitutes as a depression. A recession is where the GDP of a country contracts for 2 quarters or more. In layman's terms, this means 6 months. 2 quarters, a month each is 6 months. And you'll notice through all of my economics and finance videos, yes, I could use lots of big complicated words, but actually I prefer to make this really, really simple. The way I do my economics and finances, I take all these very complex theories and things and I break it down so it's into simple language that anybody can understand. However, that's not the only way that we measure a recession, just in the shrinkage of the GDP. Economists also look for these 5 things. So first is GDP. So let me tell you what that is. That stands for gross domestic product. So in really simple terms, what that means is all the products and services that were created in the country, like the USA, for example, in a period of, let's say, 1 year. So all these products and services get added up in a monetary value, and that gives us the GDP. When the GDP contracts, so that means it shrinks, gets less, for 2 quarters or more, again 6 months, that constitutes as a recession. The second thing that economists look at is the unemployment rate. In the last recession, the 2008 recession, unemployment hit approximately 9%, which you may think doesn't sound like a lot. But when you look at the fact we have 330 million people in the USA, that accounts for roughly 30 million people. That's a lot of mouths to feed, as well as those people's children. Number 3 is household income. In recent years, our attitudes towards our income has changed dramatically. Where before, in previous generations, the emphasis was on saving a proportion of the paycheck, possibly 20%, for example. Whereas now the majority of people spend 100% of their paycheck, and a lot of people even spend more than 100% by living on credit, because you've got to have the latest car and gadgets, right, bro? But in recessions, wages tend to stagnate. That means they sort of plateau, flatline, and they often decline. This is a big problem. This means then that there are more people competing for less jobs. That's really crucial. It's a simple case of supply and demand. So what do you think happens? Salaries reduce, because employers know that there's more people looking for those less jobs, so they start to pay less money. Number 4 is retail sales. When retail sales start to go down, this is a telltale sign that a recession may be about to kick in. And the 5th and final thing economists look for is a reduction in manufacturing. This is often the first industry to be affected, because if people are spending less on retail, it means there is less demand for the manufacturers to provide those retailers. So this is the 5th and final warning of a potential recession. A financial recession is hugely damaging to the economy because it means there's less money in circulation. This is usually because of higher unemployment, and it means that basically people aren't spending as much money. That means you. As a result, businesses are making less money, so they start to make cutbacks. And these cutbacks are usually in the form of employees, which again means you. This then creates a vicious spiral which gets worse and worse and worse, going downwards, because now we've got higher unemployment, and it means that you've got less money, which means you're spending less money. This then has a knock-on effect for larger purchases such as home loans, cars, and loan payments in general. Once people start missing these payments, repossessions then become higher, or foreclosures, such as what happened in the 2008 housing crash. Because if you've ever got behind on a payment before, you know how difficult it is to catch up. And the further behind you get, the harder it is to catch up. This can then result in the bank flooding the market with foreclosures on houses, for example. And it isn't always the case, but sometimes flooding the market with too many foreclosures or too many houses then reduces the price of houses in general. However, one major misconception that even the famous economists get wrong is that they say that when the banks flood the market with houses, this is what causes a housing recession. That's not strictly true, because if there's one thing I've realized and learned over the last 15 years of being in the real estate market, is that the price of housing is not always dictated by supply and demand. In certain countries such as the UK, it is heavily influenced by supply and demand because it's a small island and there isn't any more space for building new houses. But in places like the US, where there's a lot of land available, huge areas of land for new developments, the housing market is really a reflection of the availability of credit. The easier credit is to obtain, the higher house prices go, because just think about it. If you go and look for a house to buy, are you looking at the price or are you going to look at your monthly affordability? I think that's what most people do. They go to their broker or their mortgage advisor and they say, this is my salary, my annual salary, what can I afford? But as we saw in 2008, right across the Western world, as credit became more expensive, people couldn't afford the same value of house. So what happened was the house values actually reduced. A perfect example of this that I always give is the Help to Buy scheme in the United Kingdom, which I think is a terrible scheme. I've said it since day one, it's a terrible scheme because all it's doing is it's taking people who couldn't afford an old house that was fairly low cost before, and it's then getting them into brand new houses which are overpriced based on a monthly payment, with the government making up sometimes 50% of the other payment. Seems a good idea in principle, but all this is done because of the ease of getting into the market is it's pushed up house prices right across the country. Terrible scheme. And talking of drops, why don't you drop me a comment below? Let me know what you think of this video, and while you're there, go ahead and click that like button for me. But in all seriousness, guys, I do read all of your comments, and I do mean all. All right, so now we've talked about what constitutes as a recession, let's now go on to what constitutes as a depression. Many economists say that a depression is so rare that it takes a cataclysmic event to even start one, such as a meteor hitting the Earth, for example. Or maybe a global virus spreading across the world, perhaps. A depression is a much more serious recession that lasts for 2 years or more. So less than 2 years, and it's probably not a depression. In my humble opinion, because I'm not a Nobel Prize winning economist, many experts say that the Great Depression was actually as a result of 2 recessions that combined into one. These 2 recessions were 1929 to 1933, about a 3.5 year period. And then the second wave came in around about 1937 to 1938, about a 1 year period. Many experts believe that the Great Depression was caused by mistakes in financial monetary policy, made by, again, my favorite private, non-federal institution, the Federal Reserve. In the last 180 years then, we've had 30 recessions, which equals about 1 every 6 years. But in that same 180-year period, we've only had 1 Great Depression, which was the 1929 Great Depression, meaning 1 depression per 180 years, for example. Or as one of my subscribers pointed out, it's actually 1 in 100 billion years. So we could say that a recession is about 30 times more common than a depression. And because we only got data from 1 depression to go off, I'm going to go into that data now. Again, number 1 was the GDP. Again, that's the gross domestic product of the country, or all the goods and services produced by the country in that period. That grinded to a halt. I mean, like, it stopped. It completely stopped. Number 2 was house prices, and these dropped by 30%. Unemployment. This reached a whopping 25%. That accounts for almost 80 million people by today's standards. And when you compare this to the last recession, where unemployment peaked at about 11% in 2009, that's a huge difference, meaning more than double the amount of people out of work. Number 4 is retail sales. During the Great Depression, retail sales just fell off a cliff. They pretty much stopped completely. And not only that, but prices actually dropped by a whopping 10% as well. Now, you might think this is a good thing. This could mean that your family car that might be, say, 30K drops to, say, 27K. But actually, this isn't good, because what happens is people start to hoard their money because they're just waiting and expecting prices to drop more. And if you know about economics, this is bad because it then becomes a self-fulfilling prophecy. This is known as deflation. And believe me, we do not want deflation. This is real bad. So the fallout from a recession is pretty bad, but in comparison, the fallout from a depression is not even worth thinking about. It's so bad that it goes on for decades and decades afterwards. I remember a story that my wife's father told me where he grew up in rural Pennsylvania through the Great Depression, and he said that they were so poor that he would go down to the coal cellar and just chew on coal and sometimes eat the coal just to fill his stomach, because there weren't any 99-cent cheeseburgers back then. But jokes aside, there's one key distinction that I do need to mention, and that is that during the Great Depression, global trade reduced by a whopping 65% between 1929 and 1933. So of all the things mentioned previously, this is the one that I'm the most concerned about, because we know that right now, with all the countries closed and borders closed, trade has really grinded to a halt. So if anything was to push us into a depression, it's probably going to be that. This is why I believe people like the president and the prime minister and other world leaders want to get the borders opened as quickly as possible, because the longer the borders are closed, it means the lower our GDPs drop, causing potentially a global depression. So there's a lot of fear-mongering going on right now, even with experts claiming that we're about to go into the next Great Depression. Only the second depression that we've ever had as a species. In my next upcoming video, I'm going to go into a detailed analysis. This has literally taken me a week to do, to give you my thoughts and opinion on whether or not we are going to go into a global depression. So guys, if you've watched this far, I really appreciate it. I hope you've clicked that like button for me. If not, please do that now. And if you're not subscribed, get subscribed so you can get all these videos as and when they come out. All right, see you soon.